All right, let's finish up the week on this anniversary of 9/11 with a highlight that is important for the being wrong crowd. You're going to be wrong. You're in an industry that you'll be rewarded for being wrong if you're good at being wrong. What does that mean? Well, around 9:05 Central, I was dead wrong, not in a trade, but in an opinion. Right in here, look at the bottom of the screen, thinking that the market, not just thinking, but there was a high probability below that yellow line there were going to be some sell stops and there was going to be some downside action. This is the NASDAQ, all right? And the NASDAQ gets pretty whippy. And I'm pretty good at calling breakouts, especially in that market. As you could see, the market rallies quite a bit, about 50 points out of the hole. But you look at all of these lows in here, right? And you got people who are long inside this box, nervous if it gets below there. That's what creates the breakout to the downside. But I was dead wrong. I was willing to admit that I was wrong in here, not up here. And I even said, if I had sold that, I'd be out and it'd be this kind of loser. Maybe I was short in the ES, let's say, in anticipation they were going to break out here. I'd have been out much sooner rather than later here than here. So you don't have to get killed every time you're dead wrong. You don't have to get killed every time you're dead wrong, or you don't have to have giant losers every time you're dead wrong. You just have to know where you're wrong at. And the reason why in here I knew I was wrong, and not, it's obvious up there, I knew you would know you were wrong. A fifth grader knows they're wrong up there. They already got tears in their eyes. But you got to look at perspective. In the middle of this is where the shorts are the ones that start becoming nervous. So if you're bearish or short, damn it, you don't want to be nervous with them all the way up another 40 or 50 points. And you certainly don't want to do this, because this is what a lot of people will do in their trading. And it's a really bad habit. They don't understand what goes on inside a trade. They just look at the results sometimes. And the results could be very, very, very deceiving when you just pull out results and look at them statistically. And I think a lot of people have fallen and been trapped in analyzing all this data from COVID-19, because there's all different ways to massage numbers to get them to look like what you want. So you got to be careful. And then you get a lot of amateurs trying to think that they're expert in analyzing different data, and they hear this or that. But you got to be careful when you look at a trade. It starts, let's say, at that X and it ends at that X. This is your entry, and let's say this is your exit. This is just a generic example. Well, your stats are just going to show you what the results are. I got long here, I sold it and got out here. Out here, and it was a 3-tick winner. So your stats say you took a 3-tick winner. It was a winner and it was a 3-tick winner. And there's some other information you could pull from it. But here's what's important. What the hell happened in here? What happened in between when you opened and closed the position? Not just what did the price do? How much heat did you take? How much reward did you leave on the table? But what was your emotional disposition? If you open a position in this box and close it over here, and the market did nothing but go against you, and then you took a scratch, it'll say, oh, that was a scratch break even. That couldn't be further from the truth as to how bad this trade was. All the heat you took, you're missing that. Yeah, you could show how much time you were in the trade. Yeah, there's max drawdown that some stats show, but people don't look at the high-low of the trade as much as they do as the result. You got to look at the high-low of the trade. What happened inside the trade? What's the max drawdown? What's the max high? And even though there's some stats that could keep that, that's breaking into underneath the result. The surface is the result, win or lose or scratch, and then how much. Beneath the surface is what did the trade do physically? And then what did it do mentally? What does it mean? What did the trade do mentally? How did you feel in this trade? So you open this trade over here and you close it over here. Let's clear some of this drawing. Let's say you open a trade here and you close it here. All right. And every time, the trade went against you, let's draw this properly because this is important. The market opened there and the market closed, or not the market. You opened a trade here and you got out of it there. It was a long and it's a winner. All right. So what did the market do? Well, the market did this, went against you. Okay, that wasn't bad. That's what price did. All right. Not too bad. You withstood this test and everything else. But that's how and what price did. How about you? What did you feel like? What if every time this red line I'm going to draw goes up, it's a lot of emotion? So when the price was going your way, it was right here. When it was going down, it was up here and it stayed up here. It's like, wait a second. That might not be a really good emotional disposition that you had to manage the trade properly going forward. So there's a lot that goes on in between a trade opening and closing it or before that you don't have in your statistics. No stat will pull those out. And so it's important to know that there's more than meets the eye. And I even got this verbal journal that helps a lot of people understand talking through a trade, talking about how they feel to make it efficient and easy to document that. But here's the real life example of, let's say a person were to short it down there thinking it's going to break out. I didn't, but there are times that if I did, I could tell you what I wouldn't do. I wouldn't be in it when it did this and then come back and say, yep, see, it went down. That's absolutely ridiculous that anybody would say that or even trade it that way. All right. Number one, you minimize your risk by knowing where you're going to get out before you get in. Being dead wrong doesn't mean you have to lose a ton. It just means you have to know where you're dead wrong before you make the judgment, before you lay out the trade or lay out the opinion. Those that would get short down here in this first red box, take all this heat and then take a scratch. Again, the statistic is, it was just a scratch. And you dig a little deeper. Yeah, but your max 60 points is your max drawdown. And again, dig a little deeper. What was the max drawdown? Or some people leave a lot of money on the table. They get long here, the market goes up, and they scratch it. It's like, man, you had a 10-point winner. You keep letting 10-point winners go. They're not looking at those max drawdowns or targets. So what they do is, hey, you're finding good enough locations for a 5-point winner, but not for a 50-point winner. Your eyes are bigger than your stomach. Your locations aren't good enough for a 50-point winner. This all comes down to locations and tempo and volatility in a particular index. So if you're not kind of analyzing that, you're going to say, my locations are good enough to get a head start on X, but not Y. And I'm looking for too much. And if you say, well, I'm not here to, only look for, 8 tick winners. I need 10 points in the ES. I had a guy tell me that. He said, but Anthony, I look for 10 and 20 point S&P winners, not 10 tick winners. And I said, I like 2 blondes and a brunette, but it's not always possible, bud. I think he understood that he wasn't being realistic into what he was trying to get. Man, it's hard to get 20-point winners in the ES, especially on days where it's a 15-point range. You're looking for a damn trade outside the range of the session. Now, people don't get that or understand it. So stay safe this weekend. Subscribe to this channel and always know being wrong is okay.